Hi, I'm back with Chapter 6, and this is the last chapter in the accounting cycle. This is called Closing Entries, or the closing process. And we're going to close some of these accounts. Here you can see I have accounts ranging from assets through expenses, all of the different groups of accounts that we have. We're going to close some of these, and the ones that we're going to close are called the temporary accounts. We only use them temporarily during that period of time, whether it's a month or a quarter or a year. We use those accounts, we accumulate the money in them, and at the end of that period of time, we close them out, meaning we're going to take the money out so that for the new period, we can start accumulating money in that new period. So we don't mix one month up with the next, in other words, or 1 year with the next. We stop and we see how much, for instance, that this company earned for this month. We're going to have the month of August for this particular example that I'm going to show you. So, for instance, I have fees earned, $5,000. So this is how much this company earned for the month of August. Wages, they paid $1,000 in wages for the month. Rent, the $700 is for 1 month. The depreciation is for 1 month. So we're going to have two groups of accounts. We're going to have our permanent accounts and our temporary accounts. So I explained to you what the temporary was. Now the permanent accounts are accounts that do not close, that the balance carries over from 1 month to the next. Cash, for instance, at the end of July the 31st at 11:59 at night, if you have $2,500 in the bank, at 1 minute after midnight on August the 1st, you're still going to have $2,500. That a balance carries over to the new month. So we're going to close out our temporary accounts to get these accounts ready to accumulate the balances for the next month. And we're going to also update our capital account. Let me put in how much capital. This company has $3,000 in capital. Now this is in capital, this is the plus side. Wherever the money is sitting is the plus side. That means you have money in that account. So this $3,000 in capital is how much this business had on the 1st of August. So now it is the August 31st, the last day in August, and we want to close out our temporary accounts and update the capital account with the new balance. The balance that would be on the statement of the owner's equity, in other words, where it's showing the new balance at the end of August, if we were doing a statement for this business. Alright, so I'm going to show you your closing process. There are 4 steps in the closing process, and we're going to close the revenue account first. So revenue is closed first. So if we look at the revenue account, you'll see that we have $5,000 sitting on the credit side, your plus side. So if I want to take $5,000 out, I need to put that $5,000 on the minus side. I'm going to put in parentheses here so you can actually see I'm going to subtract 5,000 from 5,000. So when I do, that means that this account now has a 0 balance. And I believe your book just puts a dash to show that it's 0. So I took the $5,000 out of the revenue account. So we can't just leave it floating around. We have to put it somewhere. So this is a new account, a new temporary account called Income Summary, and we use it to help us close. Only use it for closing at the end of the period. So if I debited my revenue, I need a credit somewhere. So I'm going to credit Income Summary for the amount of my revenue, which is $5,000. So in other words, I took the money out of revenue and I gave it to Income Summary. So now my revenue account is closed. I'm going to write in my journal what I just did, and this would be, you would put closing entries, but you'd write closing entries here. I don't have a lot of room, so I just need to start with my account closing process. So I'm going to write my debit first. I debited fees, so I'm going to say fees earned. It's hard to write sideways like this. Sorry, it's so messy. And I'm going to put 5,000 in the debit column, and I'm going to put income summary credit. So I'm just recording what I just did. I did it in my T account so you can see clearly why and where the numbers are going. So income summary is the credit. So here's my debit and credit, my first closing entry. My second closing entry, I close the expenses next. Revenue first, then the expenses. So you want to close each expense out. I have 3 expenses. They are sitting on the debit side. So I'm going to credit each one to close it out. So I'm going to put wage expense, 1,000. Credit, which closes my wages. I'm taking 1,000 out. I'm going to credit 700 to the expenses. I'm closing the expense. And I'm going to credit 100 for the depreciation, which closes all 3 of those. So now I have, let's see how much money I took out. 1,000 plus 700, 1,700 plus 1. $1,800 that is floating around. So I have to give it to something. I'm going to give it to this new account, income summary. It's like a clearinghouse, an empty bucket, and we dump in the money in there. So if I credited expenses, credit, I have to debit income summary. And I'm going to debit income summary for $1,800 for the total of my expenses. I could put them each separately in there, 1,000, 700, 100, but why do that? It's much simpler just to add them up, put the total. So now I'm going to record that entry. Write my debit first, which I'm going to say income summary. I'm just abbreviating here. Income summary is the debit for $1,800. And I'm going to write my 3 expenses. I have wage expense, which is a credit of 1,000. I'm going to have rent expense, a credit of 700, and depreciation expense, a credit of 100. All right, so now I journalized my second closing entry. My third closing entry is I'm going to go to income summary now. I need to close out income summary. And look what's in income summary. My revenue and my expenses. Do you remember what the formula is for finding a net income or a net loss? It is the difference between the revenue and expenses. And this person earned more money than they spent for the month. So they made a profit, which is called a net income. So right now, before I close out, I have a balance in this account because I have 2 numbers that are not equal. So there's money left in this account on the credit side. So if I subtracted $1,800 from $5,000, I would end up with $3,200. So this account now has a balance of $3,200. This is my profit of the business, my net income. So now I want to take that money out and I want to give it to the owner of the business. He made a profit, so I want to credit his account. I want to put it right there. So my third closing entry is I'm going to debit $3,200 to the income summary. And when I do, it equals my credit side, so I have a 0. I took $3,200 out, and I'm going to give it to the capital account. $3,200. Oh my goodness. The $3,000 looks terrible. Anyway, $3,000, it's not much better, but anyway, it's $3,200. So now I'm going to write this entry that I did. I did a debit and a credit entry. So I'm going to say income summary. I'm going to write the debit first. So I debited income summary for $3,200, and I credited capital for $3,200. Okay, so now my income summary is closed. Capital now has a profit in here. Actually, Capital now has a new balance because we have a number under each other. So we have $6,200 now in Capital. So we put his profit in there. All right, now the drawing account, which I left out my drawing, $300. This should be $300. Okay. All right. That number is sitting there. He withdrew $300 this month. This is my last temporary account that I need to close. Everything after Capital should end up with a 0. So I'm going to close the drawing account. So I'm going to take the $300 out, which means I'm going to credit the drawing. So both sides equal 300, 0 balance, and debit the Capital. He took 300 out of the business during the month. So that is a decrease to the Capital. So I'm going to write now my last closing entry, which was Capital was my debit. So I'm going to write Capital first. We always write the debit first. So Capital, 300 debit, and the drawing I credited to close it out. Drawing is on the credit side. Now, I need to update my Capital. So I have a $6,200 credit and a $300 debit. So I'm going to subtract 300 from 6,200. So that would be 0, 0, 9, and 5. $5,900, that would be. $5,900 would be the new Capital balance. Now after you finish doing your closing entries, look to see and make sure that every account after Capital, drawing, income summary, revenue, and expenses have been closed out. The only accounts left now with a balance would be your permanent accounts, which are your assets, liability, and capital. So now we want to check ourselves to see if we did this correctly. So the last thing we would do, I'm going to erase this quickly, and this is going to be what we call a post-closing trial balance. So every time you fool with your ledgers, you got to do a trial balance to make sure that you did it correctly. So easy, as you might know now, to make a mistake. And my goodness, especially me, when I'm trying to add up and subtract in my head. So anyway, I'm going to write down only my accounts that are left open. So I have cash. I have a balance of $2,500 on the debit side. Accounts receivable, I have still open. It doesn't close. I have $800. Equipment, I have a balance of $3,800. These are debit balances, but now the accumulated depreciation on that equipment is going to be a credit of $200. That means that that equipment has lost $200 in value. Accounts payable, all of these are still open. They didn't close out. He still owes money. Even though it's a new month, it doesn't go away. You still got a balance that you owe the credit card. And capital, this is the new capital balance, $5,900. All right, I'm finished because the rest of my accounts, I don't have any money left in it. I took the money out. So now add up, and let's hope that both of these come out correctly. So we have 8 and 8, 16, I think 23. So we have 4, 5, 6, 7,300. And over here, 7,100. So it doesn't come out right. Let's see if I'm doing a 16th. Oh, I added wrong. See, I needed my calculator. 7,100. Both sides equals 7,100. So when you make a mistake, go back and add it again or subtract again. So that means that I have the correct numbers in here when your trial balance comes out. Okay, this is only for you to see. Check yourself. You're ready to go to the new period now, and you just continue with your posting. After you journalize, you post, and you start, for instance, next month, he'll have another 700 in here. In other words, this is going to be August the 1st, and then, so September the 1st, when he has another 700, it would be for the month of September. It wouldn't be 1,400, because this is 0, we're starting from the beginning, and that would be 700. But anyway, right now we don't need that. So if you have any questions, please let me know, and I'll be glad to answer you or help you. Thank you. Bye-bye.